Welcome to Market Momentum, where we cut through all the noise to figure out what's really driving the markets. Okay, let's just dive right into this, shall we? This is probably the biggest conflict facing every single investor today. You've got these scary headlines on one side, and then you have the actual market performance on the other. Who do you believe? It's incredibly confusing, so let's try and break it all down.
All right, first up, we have got to talk about this constant, just barrage of fear-inducing news. I mean, if you can't see past this, you're flying blind. And who could forget this one? A single tweet, just one word, sell, from Michael Burry, the guy who famously called the 2008 crisis. That one word sent this massive shockwave of panic through the market. Everyone just assumed he was talking about stocks and started heading for the exits. And then this happened. A 75% gain in the S&P 500 since that sell call. I mean, look at that number. It's the perfect, and I mean perfect illustration of just how dangerous it is to blindly follow the big names without doing your own homework. That is a life-changing move to miss out on because of a tweet. Burry's tweet was really just the tip of the iceberg. We have been swimming in this sea of scary stories for months now. You see headlines like these everywhere, right? And every single one is designed to do one thing: spark fear and push you into making an emotional, knee-jerk decision. So that begs the question, if the headlines are all screaming danger, why have U.S. stocks, we're talking the S&P 500, the Nasdaq, you name it, been so incredibly resilient? Let's push all that noise aside for a second and actually dig into the data. What's going on here is this fascinating tug of war. So on one side, you have these huge institutional funds that, well, they missed the rally. And now they're battling a serious case of FOMO, the fear of missing out. They're scared of being left even further behind. But on the other side, you have everyday retail investors who are looking at every single dip as a golden buying opportunity. So kind of paradoxically, you have both fear and optimism creating this really strong floor for the market. And the numbers, well, they just don't lie. Despite all the doom and gloom, the market has just relentlessly climbed higher and higher. I mean, look at these gains. It just goes to show you that what you hear in the media and what the market is actually doing can be two completely different realities. And the charts, the technicals, they totally back this up. The major indices like the Nasdaq and the Dow Jones, they're still in these really clear uptrends. They're holding strong above key support levels like their moving averages. So the underlying strength, it's still there. Okay, so let's shift gears a little bit. We've talked about stocks, but what about the other big players? Crypto, gold, silver. Over here, the picture looks quite a bit different. So I'll be totally honest with you. My personal bias here leans toward caution. You see, unlike stocks, which are at least anchored to things like company earnings and actual cash flow, assets like crypto and precious metals are driven so much more by pure sentiment and momentum. Now, that can lead to absolutely explosive gains, for sure, but the sell-offs, they can be just as brutal because there isn't really a fundamental floor, a valuation to stop the bleeding. This table here kind of breaks it all down for us. So with Bitcoin, we see it's in a correction. What does that mean? It's just pulling back from its recent highs, which makes jumping in with new money pretty risky until it finds some solid ground. Then you've got gold, which is in a sideways consolidation. Basically, it's just catching its breath, moving sideways below a key price ceiling, building up energy for its next big move. And silver? It's testing support. That just means it's revisiting a price level that has held strong in the past. So what's the big takeaway for all three? Patience. This is not the time to be aggressive. So when we zoom out, you can really see that each of these asset classes has its own unique personality, its own timeline. Stocks are climbing that wall of worry, crypto is in this wild, volatile correction, and the metals are just kind of chilling, consolidating. And it's exactly this difference in performance that baits investors into making what is, without a doubt, the single biggest, most wealth-destroying mistake you can possibly make. Okay, I really need you to pay close attention here because this is, by far, the most important part of our entire analysis today. Understanding this psychological trap is what separates the successful investors from the ones who just seem to lose money over and over again. I get questions like this all the time. Hey, I just sold my gold. Should I use that cash to buy stocks? Or I just sold my crypto. Is now the time to buy gold? They sound different, right? But they all point to the exact same really dangerous impulse: performance chasing. It's this desperate need to always be in whatever the hottest asset is at that exact moment. And that is the trap. It's this belief that you can perfectly time the market, that you can sell an asset that's down and immediately hop into another one that's already shot up. It's an attempt to be too smart, you know? And it almost always backfires because what you're really doing is forcing yourself to sell low and buy high, the exact opposite of what you want.
So here's exactly how that vicious cycle plays out. First, you panic. You sell your gold after it takes a little dip. Then you see stocks are soaring and FOMO kicks in hard. You jump in. So what's the classic next move in this story? Of course, gold starts to recover the second you sold it, and stocks decide to pull back right after you bought them. And the result is a complete disaster. You've now locked in a loss, and you've missed out on opportunities on both sides of the trade.
So, okay, if chasing performance is the trap, how in the world do we avoid it? How do we invest with a clear head and a solid game plan?
You have to remember this. The smartest trade is often no trade at all. Sometimes the best thing you can do is nothing. Cash is a position. If you've sold an asset, say gold or crypto, and you're waiting for a better price to get back in, just waiting in cash is a perfectly valid and, frankly, often a far superior strategy. So what's the big takeaway from all of this? It's simple, really. Develop a separate, independent strategy for each asset class you care about, whether that's US stocks, crypto, or precious metals. And then, and this is the hard part, have the discipline to actually stick with it, instead of jumping around frantically every time you feel fear or greed.
And that's a wrap for this market update. Thanks so much for joining our channel. We'd really appreciate it if you consider subscribing and liking. It helps us a lot.